Welcome to Next Gen Rentals, the go-to podcast for exploring the evolving landscape of the vacation rental ecosystem. Here, we deep dive into the world of vacation rentals, share experiences, and tackle the industry's biggest challenges. Each episode features conversations with key players in the rental space, discussing everything from technology innovations to market dynamics.
Next Gen Rentals is brought to you by our main sponsor, Mr.Alfred. Mr.Alfred specializes in making vacation rental management effortless. Stay tuned to discover how they can transform your rental business.
Hello, everyone. Welcome to the new episode of the Next Gen Rentals podcast. Today we have with us Siddiq Farid, who is the founder and CEO of Smartcrowd and a very good friend. So Siddiq, can you explain a little bit what's Smartcrowd?
Sure, yeah. Thanks for having me. It's been a while.
It's been a while.
Yeah, we've been through a lot together. I remember, as you were mentioning friends, I remember us spending some time in Lisbon at Web Summit in 2018. I don't know if you recall or not. You and me.
Absolutely.
Mickey, yeah, it was a good time.
It's true. And Mickey went there last week. Our partner went there last week. So.
Cool. Yeah, no, so Smartcrowd, it's a simple idea. It's a digital platform that enables micro investments into real estate, enabling access to real estate to the masses. We felt like it's an asset class that everybody wants to invest in, but a lot of people struggle mainly due to capital requirements. Real estate is a very chunky investment, requires a lot of capital. That's one problem that people have to deploy capital in real estate. Second is people don't have the ability to source deals. And third, people don't have the ability to evaluate and make the right effective decision. So we solve these three problems through our digital platform. One, by fractionalizing the real estate, allowing people to invest as little as 500 dirhams, you can get access to the asset class. Second, we give them access to pre-vetted investment opportunities, so we do the deal sourcing. And third, we provide them with all the data one would require to make an effective decision. So we solve all those problems through our digital platform.
So I understand that by fractionalizing, you spend less money, you invest less money in real estate. So what's the minimum spent in your platform?
So the minimum investment on our platform is 500 dirhams.
Dirhams.
Yeah, but the average ticket for investors is about 5,000 dirhams or so, depending on different kinds of assets and where the investors are coming from. And the idea there is, if you have 50,000 dirhams to invest in real estate, you don't have many options with 50,000 dirhams, right? Buying direct real estate. But there's hundreds of people with 50,000 dirhams that want to invest in real estate but don't have the option. But imagine bringing those 100 people together, 50,000 each. All of a sudden you have a massive purchasing power, right? And then you can go into the market collectively and take advantage of opportunities like the wealthy do. And that's what we've been trying to preach to people is like when you put that kind of money together with other people, like-minded investors, you have better value for your money. Mm-hmm. And the other beauty thing of doing, another advantage of investing in a platform like Smartcrowd is it allows you to diversify your money into various different properties. So even 50,000 dirhams, you don't have to put it into one single property. You can invest 10,000 in 5 different properties on the platform. What that does, it spreads your money into 5 different properties. One might not perform well, the other 4 might. Or if you need liquidity and the market is not in your favor, you can sell shares in one property, incur some losses because you need liquidity, but still have some investments left over to recoup any losses that you made on one property. Whereas if you put all your money in one asset, if you need liquidity, you need to sell, and the market is not in your favor, you incur those losses, and that's it. You crystallize your losses.
And these 5,000 dirhams, I think you mentioned, no? Average ticket?
500.
Average ticket? 5,000.
Average ticket is about 5,000 dirhams, yeah.
It's only one property or it's diversified in different properties?
One. So average person has about 4 properties. Okay. So, on average, people are putting between 20,000 to 30,000 dirhams on the platform.
Very interesting.
We have people that do one investment just to test it out, and we've had people that had 30, 40 investments totaling, close to 1 million dirhams on the platform, for example.
And you mentioned that it's much more liquid than traditional real estate. Is there because you have a secondary market? Or
so liquidity, so direct real estate, is generally a very illiquid asset compared to public equities and so forth, right? But that's not necessarily a bad thing, right? The illiquidity or liquidity comes at a price. So because it's illiquid, it has less volatility, so less risk in terms of price movement up and down and so forth. But on our platform, we provide 2 forms of exit One is a collective exit where we sell the entire property and everybody gets their capital back along with any capital gains, which we have done a few of those. We can talk about that later. Or we offer exit windows twice a year, 6 months apart, where people can come and sell their shares. So you can list your shares at whatever price you want. We do independent valuation. We do performance updates, so the buyers and sellers are fully aware of how the property is performed, what the value of the property is, and you as an owner of shares can list whatever price depending on your condition, how aggressively you want to sell, or if you want to be an opportunistic seller, sell it at a premium, or if you want to be aggressive, you can price it at a discount. And other investors on the platform, either people existing investors in the same property or people that want to get into that particular property for whatever reason, can purchase shares from you. So there's two forms of exit. Obviously that secondary or the share transfer facility over time, as liquidity increases on the platform, people get more active, that liquidity will increase over time. But I wouldn't say it's necessarily more liquid than traditional asset class, right? You're still investing in indirect real estate. But what we preach to our users, our investors rather, is long-term investments, right? And real estate has proven the longer you hold, the more returns you make because it provides you a steady flow of income. And if you're disciplined enough to reinvest that in returns that are coming from a rental income, you can compound your investment and really accumulate wealth that way in a very patient, smart way.
Excellent. I understand that this secondary market or marketplace or I don't know how or exit windows that you created implies a heavy legislation and regulation. I understand you were the first one, the first crowdfunding for real estate regulated in MENA?
Correct.
So how the regulation works and what's the protection of an investor that invests in a financial product, I would say, but also real estate?
Yeah, no, it's a very good question. So, regulations were very important for us. So before we started operations to the public, we took the effort to get financially regulated. And like you said, we were the first one. So there was no rules and regulations, but there was also no legal structures to structure these investments. So, for our sins, we were the first ones, and it took a long time. Right? We spent 2 years to just convincing the stakeholders and getting the right framework in place. So we paved the way for many other platforms to come, not just in Dubai, but also regionally as well too. So alhamdulillah, we have many first of its kind accolades, which we're very proud of, Smartcrowd team, because we delivered a lot of different things that are first of its kind in the region. But the beauty of the regulation is that it gives investors protection in the sense that the way these investments are structured, they're completely ring-fenced and segregated from Smartcrowd operations. So even if Smartcrowd is an ongoing concern, your investment doesn't get impacted because all these assets are separately set up in a separate SPV, a special purpose vehicle that is set up for each property. So if you have 10 people that contribute capital to buy a particular property, they will own shares in SPV, and that SPV will own the asset. And this is public information on the DFC public register. You can go put in the company name, the SPV name, and see the shareholders. The same information is registered with the land department. So no one can argue that this particular person owns 10% of this company that owns the property. So you have full legal recourse from that perspective. Smartcrowd is there just to administer the SPV on the behalf of the investors to facilitate all the transactions and so forth. So that gives the investor a lot of protection. And the proof is in the pudding, right? We've been doing this for almost 4 years publicly since COVID. We became operational just before COVID, actually, to the public. That's when we got our full license from the regulators. And we've done a few exits already as well, too, to prove the whole investment cycle. And we've done 3 exit windows as well, too, since our infancy. Yeah.
So let's go to the numbers then. So you started 5 years ago, the company, 3 years and a half, almost 4 operationally. So how many units have you funded so far?
So collectively as a group, we have funded over 100 plus properties on the platform. We've given out almost 10 million dirhams in income, dividend income, to rental income to our investors, net of all charges, fees, etc. Cash on cash return on our portfolio has been just around 7%. Obviously, past results are not indicative of future results. Just want to get that out clear. And we've done 18 exits, since we started, which is very important because, a lot of people used to ask us at the early days, like, okay, great, platform is fantastic. It's very easy for me to put money in. Can I get my money back? And we've proven that, right? 18 exits. It's almost, about 20% of our portfolio
Correct.
that we've turned over.
In 3 years.
In 3 years. And the average holding period has been 33 months with average annualized return in the high teens, total return close to 30%, 35%, if I'm not mistaken. So pretty good returns over the last 3 years if you compare to any of the asset classes in terms of what's happening with the public equities or gold or Bitcoin, et cetera. You can compare, right? And the whole idea there is this is not an or, it's an and that's what we enable, right? Because if somebody has $100,000 to invest, forget buying real estate. You can't, right? You only are restricted to buying stocks, bonds, or other alternatives like gold, Bitcoin, whatever. But with Smartcrowd, it enables you, hey, you can take 100,000, you can take 20% allocation and get real estate exposure. So you get a nice diversified portfolio like the wealthy have.
Yeah, and from a business perspective, how did you see your, how would you describe your first mover advantage versus being the one educating the market, no? Because there is a lot of debate about first mover or second mover advantage.
Great. Like you're an MBA as well too, right? We've studied business and economics, etc. First mover advantage is not always necessarily an advantage. In hindsight, I think it obviously has a lot of benefits because you're the first one. You get a lot of credibility. You get a seat at the table to dictate, a lot of the avenues in terms of how the rules and regulations. You can build a lot of credibility with the stakeholders, but you do all the hard work and pave the way for other people to come and follow, and it's much easier for them to get started. It takes them less time, so their money is better spent, etc., and so forth. So I wouldn't necessarily this necessarily has been a massive advantage to us. There's elements of it that's really been very helpful, right? We have a good track record, we have good credibility, good reputation in the market for paving the way, being pioneers in the space. But we also started back in 2018 before the whole startup scene really blew up in MENA. I remember, I don't know if you recall, right? When we started in 2018, seed rounds or pre-seed rounds were like $500,000, and we were like, wow, that's crazy, it's amazing, right? By the time we became operational, the whole startup scene was, was very popular, and people were raising $2 million, $3 million on PowerPoint presentations, right? So that's where the timing is a very critical component of this as well too, right? I think we've been very early in all our thinking and our execution, etc., which is not necessarily a bad thing. You just need to navigate. It just creates different kinds of challenges for you to solve.
And how is the market today in crowdfunding for real estate here in the UAE? Yeah,
so it's still very nascent. I think it's still a concept that is not well understood. People still get surprised. The awareness is still relatively low. There's a couple of players in the market. In Dubai, there's a couple of players in Saudi as well too. So it's gaining more attention. Globally, if you think from a global perspective, it's also a very nascent industry. It's been only around for a decade. So it's not something that's been going on for a long time. And the popularity is there. If you look at more mature markets that have been around for 10, 15 years, billions of dollars have raised on similar platforms to invest in real estate. So it appeals to people, right? Everybody wants to invest in real estate. It makes it easier.
It's the most tangible product that
it's
everyone knows.
It's the most tangible project. Culturally speaking, over here, people like to prefer
investment.
hard assets. It provides you a steady flow of income, so it allows people to create a secondary source of income. And if you're disciplined enough to compound that, it can really help you in your investment portfolio overall. So, but I think we're still sort of, in North American analogy, I would say, first, second inning of this whole space. We're big believers in the real estate asset class, especially residential real estate in particular. If you look at historically, the residential ownership has been deteriorating all over the world, mainly due to lack of affordability. People struggle to afford to buy a home, or the younger generation don't want to be indebted with having big mortgages, etc., and so forth, which means a lot more renters in the market, which makes it a very attractive investment asset class. And if you look at the smart money, the big institutional money, they've been buying single-family, multifamily homes in the hundreds of millions and billions since the financial crisis. Yet average person is getting left behind. They're the ones that are renting this, but they don't have the opportunity to put their capital to work in this asset class. And that's where the idea of Smartcrowd came. Like, hey, if we can make it a very simple, accessible platform. Just like if you were to open up a trading account and start trading in stocks, why can't you buy real estate in a similar fashion and take advantage and put your capital to work, generate income, and use that income to subsidize your rent and so forth, right? I come from a camp where I don't believe in rent is waste of money. I think, people, I think it's a mantra developed by bankers and brokers for their benefit, because they want you to buy homes to live in and get mortgages, etc., and so forth. But there's no right or wrong answer over here. But I'm the believer that if investment, it should be an asset. The moment you take on debt and you're paying, you're not earning any positive cash flow, it's not really an asset, it's a liability. I don't know if you read Rich Dad or Poor Dad. That's what preaches, and I'm a big believer in that, is there's opportunity cost of you buying a home as opposed to renting a home. Doesn't mean that you don't invest in real estate. You invest in real estate, it gives you a lot more flexibility, and then you can use the rental income to pay for your rent, or it leaves you more flexible.
Yeah, in the end, I always say that if you buy to live, you don't invest, you invest emotionally.
Correct.
Therefore, it never will be the most the asset with the most return.
100%.
Never.
100%, right?
By definition. Exactly.
So I'll give you some small things to make that point more valid, right? So when we're looking at investment opportunities, right, there's a couple of things that we keep in mind, right? What's the service charge to rent ratio, for example, right? And that is dependent on the size of the asset and so forth, right? How serviceable it is, meaning how easy is it to rent, how easy to sell, etc., and so forth. When you start looking at these things, whereas if you want to live in that unit, your mindset is completely different. I want space for my growing family. I want to be in a location that's appealing to my lifestyle and so forth. When you start looking at those things, they don't necessarily equate to maximum return, right? And this is where a lot of investors or a lot of people think, I'm going to buy a home, and that's great. And in a booming market, that's fantastic, right? Because prices are going up, you will benefit, and the mortgage rates are, attractive enough. You will, if you hold the asset long enough, you will make money one or the other. But was it the best investment in terms of maximizing your capital? Probably not, because you probably had better opportunities other places. But on the flip side, this whole concept of opportunity cost, which is very difficult to quantify. A lot of people don't think from that perspective, right? So let's say, you're well off enough to put a down payment and own a home. That's great, fantastic, right? It's probably a big investment for you and so forth. And God forbid something happens, like a COVID example, right? COVID came, a lot of people had mortgages, etc. They lost their jobs. And all of a sudden you're in a situation where, hold on, I can't make my payments. I'm in a difficult spot. Market obviously is not in my favor right now. And I'm desperate at the worst possible time, right? And if you cannot sustain that investment, that's it. You
lost all what you paid.
You're in trouble, right? And you have to pay, etc. And once you conclude that transaction, you crystallize your losses, etc. And that's it, right? It's very difficult to recover from that. You can, but very difficult. Whereas if you had rental properties for the same amount of money, and then you had rental income that slowed down, etc., and so forth, it's easier for you to manage those kinds of opportunities. Or let's look at another example. You got a job offer somewhere else, you need to move, etc. It's very difficult for you to make those decisions because you're anchored in a place where you're living, paying mortgage. If you were to rent it, if you were to leave, the numbers might not make as much sense as if it's a rental property, because it's purely from an investment perspective, and you have a lot more flexibility in the decisions you make. So there's opportunity cost. It's very overlooked very easily from people.
Okay, so just to finalize the block about the business, I understand your competition is gold, investment, stock exchange, this type of investment, rather than real estate or other competitors, no? So you are trying to get the money that people invest in this amount based on the amount rather than the asset class.
So I wouldn't necessarily a competition. Yeah, obviously, you're trying to capture the allocation from one's investment portfolio, right? Or wallet, so to speak. But it's in your better interest to ensure you have a diversified investment portfolio. This is how the wealthy are able to not only accumulate but preserve capital, right? So when we did our thesis in terms of why we want to founded Smartcrowd, it was very simple. If you look at the wealthy, they're able to manage their risk better, because investment is all about putting capital at risk. And what they are able to do is, if you look at the wealthy, a good chunk of their investment portfolio is in boring fixed assets or hard assets like real estate. Because what? It's not as volatile. It provides steady flow of income. Because if you have enough money, you can invest and you generate enough income that allows you to have a secondary source of income, allows you to take risks on more riskier opportunities, that allows you to accumulate capital over time. But an average person does not have that ability to do so. So it's in the best interest of you to diversify your capital in a way where it gives your money the best opportunity to grow and work for you. So if you're disciplined enough, you would invest some in real estate, the income that's coming from it, you would use that income and compound it into different asset classes, etc., and grow your capital in time over time. And by having that secondary source of income through rental income, it allows you to take more risks, right? Hey, you want to change careers. For example, if you take a step back to take a step forward, you can do so because you're not reliant on your salary only. You have other forms of income that's coming in to maybe subsidize your income for a short period of time as you do this transitionary period and so forth. So that's the whole idea behind that. So it's not an or, it's an and, right? So you can invest in gold, you can invest in stock market, you can invest in Bitcoin, as well as invest in real estate, because by breaking it down into smaller chunks, we have enabled that.
Mm-hmm. So you were talking about the consistency, the discipline in investing in real estate. So can you explain this secret sauce about the discipline of investment?
So the very first discipline is, you don't get rich overnight, right? Mm-hmm. It takes time. Sorry to disappoint you and your listeners. But unfortunately, a lot of retail investors, they feel like they can hit a home run and get rich overnight.
And especially after the Bitcoin era, no?
It
Bitcoin
could
didn't help in this.
No, it doesn't, right? So
this paradigm.
Exactly. So even then, right, you might be rich on paper one day, and then if you didn't cash out,
True.
you would have lost money as well too, etc. So you need to be very disciplined, right? People might get lucky. And hit the right cycle and so forth, but that's not how you typically get wealthy, right? There might be one-off, Bitcoin billionaires or millionaires and so forth, but if you look at over history, people that have done well are people that have done it over time, right? In a very disciplined fashion, etc. It allows you to sleep well at night, right? Yeah. So that's where the first discipline starts, right? Having setting the objectives.
Exactly.
What is your time horizon? What is your purpose? What are you trying to achieve with your capital and so forth? And then trickling down in terms of, hey, what is my allocation based on my risk profile, right? And risk has to be looked from two different perspectives, right? One is your willingness to take risk, that is, what kind of person you are, etc. But then the second time, the ability to take risk. Two very different things, right? You might be a very risk taker person, but your financial situation might not say that, hey, you cannot afford to take risk, right? Or vice versa. So understanding those elements is very critical. And from there, you decide, hey, where does my allocation happen and so forth. And when it comes to real estate specifically, you have to, very common mantra, real estate, location, which is important. But, when we look at real estate, for us, the number one criteria is cash flow, right? Like, how do I make money from this investment, right? Is it going to generate positive cash flow, etc.? And location is a key characteristics of that, but I wouldn't say necessarily the key element that we look at. Cash flow is very, very important, right? From that.
Because I understand location also implies higher purchase price, no? In the end, cash flow is compared to purchase price, or you look at cash flow only from a cash-in perspective?
So you're right. So certain locations will dictate, but then they will also dictate the rental opportunity for that, right? So it is the net cash impact that you want to look at, and you want to look at that on a relative basis, right? Because then you can compare apples to apples, etc. You can't just look at nominal terms, right? Oh, $1 million dirham property versus $2 million dirham property is great. Like, yes and no. I don't know, right? You have to look at the fundamentals of it, the analysis. Okay, what's my cash return on the $1 million dirham property versus $2 million dirham property? So when you look at the cash flow, you look at a specific point in time, which is fine, right? But you need to have the ability to understand that the trends and the growth of that asset and the cash flows of that as well too, in terms of what's the performance, right? So this is where the serviceability of the unit comes in very important. And what do I mean by serviceability? Serviceability is, okay, how serviceable this unit is, right? If I'm buying this investment property, it has to be attractive for renters to rent this property, because if there's not enough demand for renting this property, my occupancy rate will be very low, which means my cash flow will get hit, etc. I want a property that if my tenant leaves, it's rented within the next 10 days, right? Because then that ensures that I'm fully occupied and generating cash, etc. If I need to sell, if I need liquidity, how much interest there is from investors or end users, for example. So there's a lot of properties that make sense for both from an investor and user perspective. They're great because then you're not segmenting to one sort of demand side. You're going after a wider pool of potential buyers, etc. So serviceability of the unit is very, very critical. And then you look at location, the quality of the asset, and so forth, right? Those are, I said that. I say they're secondary, but they're also very, very critical, right? Because when you look at your numbers, to get the validity of the numbers, how strong the numbers are.
Exactly.
Qualitative factors like location, the developer, the quality of the build factors into that serviceability equation, so that captures it all.
And I guess if you can sustain it over time.
100%.
Because it can be serviced,
100%.
have a higher serviceability today, but you need to forecast the serviceability.
100%, right? So you need to look at, hey, what's happening in the supply-demand dynamics, right? Like, I'll give you examples, right? Like if you look at from 2014 peak down to 2020, Dubai average prices were down about 30%, right? Whereas Palm and downtown were down, 50% or more. Whereas JVC was down only 15% or 16%. Why? Even though there was new supply coming into JVC, because demand was high, right? People were migrating into JVC, right? It was a developing area, it was affordable, etc.
Exactly. Price point.
So
because the demand is not equal across the city,
so supply is not necessarily a bad thing.
What is the price point?
Right? Because when you looked at from 2014 till 2020, the headlines, right? Supply demand imbalance, which sounds great, sells headlines, but they don't mean anything. So stop investing based on headlines. Do your homework, because if you did the homework, supply is not a bad thing as long as there's demand to absorb the supply. And if you look at the supply demand dynamics, and you can go back and look at my YouTube channels from 2018, guys talk a lot about this dynamics. Supply peaked in 2017. Since 2017, supply has been coming down in Dubai. That might sound like a shocking statement, because when you see all these launches, etc., and so forth, a lot of these launches are relaunches of old projects that were delayed or canceled, etc., or being repackaged. But if you also look at supply launches vis-a-vis the population growth, that ratio is actually not that high. It peaked in 2017. And when we started looking at data, this is pre-COVID. We were believers that this is going to turn. And when it turns, it's going to turn in a rapid way, right? Because demand can come overnight, which COVID proved. But supply doesn't come overnight. It takes time to build stuff. And the reason we've seen what we've seen in the pricing, both in terms of capital prices as well as rental, is because of lack of supply. Supply that is readily available for people to get into. Hence the price pressure. So supply, is not necessarily a bad thing. You have to absorb all these elements into the market and make proper decisions. Don't get hyped up with the headlines, and actually do your homework. Talk to people that actually know the market, and understand there's a lot of data available, right? That's the beauty of Dubai, which is attracting a lot of more capital. It's a lot more transparency. You get access to data. There's a lot of tools available. You can go to the Dubai Land Department website to get data, and there's lots of other free tools available for you to get access to the data and make effective decisions.
Let's take a moment to thank Mr. Alfred, our sponsor. They're not just a property management system. They're a comprehensive solution for vacation rentals, offering everything from dynamic pricing to efficient marketing. Their intuitive platform simplifies operations so you can focus on growth. Excitingly, Mr. Alfred now offers a free light version, including a channel manager with connections to over 60 OTAs, available for an unlimited number of units and users. To learn more and to start streamlining your rental business, visit mr.alfred.com today.
Yeah, so basically what we read is that the problem with supply has generated this increase of prices in the last 2 to 3 years in Dubai. So how this has impacted your business? Because I would like to know also, along with this question, is what's the part or what percentage of return comes from the cash flow of rentals and capital appreciation of the asset?
That's a very good question, right? And there's no simple answer, right answer, but because it depends on the different kinds of property sales. And I'll give you some examples of that. So to answer your first question, when you're investing into real estate, which we are as a platform, we have challenges in a downward market and in a booming market. In a downward market, it's difficult because when the prices are going down, and you need to find the right assets to buy into with a long-term view. When prices are hot, it becomes difficult because then you need to compete with lots of other investors to acquire the right assets and so forth. So in both markets, it's challenging, but also creates opportunities. When markets are down, smart money comes in, takes advantage of good quality assets at good prices, because you have to understand, are these fundamental structural problems or these are cyclical problems? So Dubai, in my opinion, over the last 2 cycles haven't had any structural problems, just cyclical issues, right? So if you have that kind of a view, you can put money in at the right time and take advantage of it. And in a booming market, also you have to be very disciplined. And we've in our cycle, we started at a time where prices were still coming down in 2018 until 2020, and we've been buying throughout, right? As the prices were bottoming, as the prices have been increasing, and we've sold assets bought pre-COVID and post-COVID, and we have made money in all those, because discipline is very, 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 very important. In that. Your second part of the question was
if this change of the cycle has impacted your
returns, right? The income versus capital appreciation. So we've had exits where majority of the return has come from capital appreciation, and in some assets where the majority of the income return has come from income. So that comes down to what your strategy is going into it. So I'll give you examples of a couple of strategies that we deployed. One strategy that we deployed quite very successfully was focusing on budget holiday homes in Marina, for example, because we were and this is pre-COVID. So we were of the view that, obviously tourism is very popular in Dubai, but not everybody that comes to Dubai has a lot of money, right? People want to have affordable places to stay, whether they're coming for holidays or they're coming to stay here to look for jobs or set up a business, etc. And they want to be close proximity to public transportation, because if they can't afford fancy, expensive places, they also probably cannot afford paying for taxis, etc., and so forth. So we had a strategy of buying affordable homes on Marina on the first strip, close to the metro and the tram. So the likes of Marina Diamonds, Cascade, Marina Residence, etc., and so forth, right? Good quality, decent buildings, but nothing, fanfare about them, budget. And the focus was to maximize income on them. So if you look at the returns, and we sold those recently with the booming market. So almost 60-70% of the return on those properties came from income, because they were really cash flow positive, because that strategy worked really, really well. Occupancy on those were like close to 90%, generating phenomenal ADR, and the entry point for that was relatively low. So income was fantastic, and even with the price appreciation, we were able to generate a decent amount of capital appreciation. So a good 70% of that came from income, and the rest came from capital appreciation. I'll give you another example where we bought, or our investors on the platform bought a 2-bedroom in the Views. And this was bought purely with the indication of, hey, this is pure capital story, because it was during COVID. The seller was based in the US. They wanted their capital out, so we found a good opportunity to take advantage of. Desperate seller, doesn't know the market really well, wanted his cash out of Dubai, and was willing to let go of the asset at a very attractive price. And it was presented to the investors as, hey, this is not an income play. You'd be lucky to make 6% yield on it, but we're getting a really good attractive price, and when the cycle turns, it'll be a phenomenal capital appreciation. So we bought that 2-bedroom for 1.1 million.
Wow.
Right? At that time, the market was probably close to between 1.2, 1.3, but there wasn't many buyers at that point in time. So 1.1 million. At that time, the rent was 80, right? So 2-bedroom, service charges, etc., was making like 5 point something net yield on the asset. And by the time we sold, the rent had gone to and we have restrictions in terms of how much you can increase rent and so forth. So it would take a long time to get the rent to, the market rent was 120, 130 now, but we were rented at 90,000. But we just recently exited that 1.1 million dirham property that we bought for 1.7, right? Because that was the intention from day one. Hey, we're going to hold this for a short period of time. As the prices increase, the market increases, we will sell. So about 80% or 70% of that return came from capital appreciation, and the rest came from income. So it depends on the different strategies.
So it's part of the strategy, no?
It's part of the strategy.
And how do you balance the pressure? Because I understand as a business, you need to generate more deals, no? So how do you manage this pressure with non-attractive deals?
Yeah, so this is one of the biggest challenges to run a business, right? But for us, it's very, very clear, right? We care about our investors, number one, right? And we are more about quality over quantity. So discipline is very, very important. There'll be a time where I'll only have 2 properties on the platform just because there isn't anything attractive in the market. And that's fine, right? It hurts the business because we are a volume play. But if you look at our track record, it speaks for itself. Our reinvestment rate speaks for itself. 80% of our users are reinvestors on the 60%, sorry, are reinvestors, and of all the transactions that are done, all the AUM that we've generated, 80% of that has come from existing investors. So that speaks volumes that people trust us, and this is because they trust us because we are very disciplined. We don't just put any property on the platform. There's a lot of homework that goes into it. It goes through a proper screening process and there's enough opportunities in the market. Again, it's different strategies, right? So in different markets, we apply a different strategy. So it works, right? It is challenging. I would love to do 15, 20 properties and just do a volume play. But as awareness increases, that will come over time. And there's enough opportunities. We have a pretty good network of people that we work with to find sources of deals, etc. We're pretty active buyers. So a lot of people come to us even before a property is listed on the platform and so forth. So we're able to generate pretty attractive or get access to pretty attractive opportunities.
Okay, and for this investor that is listening to us and wants to enter real estate or wants to benchmark, what's the target rate of return that you are looking after?
So we don't necessarily typically, preach or guarantee some sort of returns and so forth, right? But if you look at Dubai as overall, right, the average yield on current market trends in terms of capital prices as well as rental is just under between 6.5-7%, depending on which publication you look at.
But this is as an income yield.
It's an income yield, right? And a gross between 6.5 to 7%.
Before financing costs.
Before financing costs, before service charges, before property management, and so forth, right? So as long as you're beating that, that's attractive. And
so you said 7 to 8%.
6.5 to 7%, depending on which publication whether you're looking at Property Monitor, Redin, DXP Interact, and so forth. That's typically the number that you will get on an average, and that includes really high-end prime real estate. It includes very affordable real estate. So when you break it down into different kind of asset type, into different areas, etc., that might go as low as 4%, as high as 10-11%. So you need to benchmark apples to apples, right? You can't compare a studio in DSO to a studio on the Palm, right? It's 2 very different asset types, providing 2 different kinds of risk profile, different kinds of returns. And that's a very important element for investors to understand, that you might get 8% in DSO, but you're not going to get 8% income in the Palm. But capital appreciation story might be very different. So that's what it comes down to, understanding the different types of asset classes. That's why I can't give you a blanket answer.
Yeah, but I understand as a general rule, the more premium areas, less yield, less premium areas, more yield, and less capital appreciation. Or in Dubai, generalization is a mistake.
Generalization is a mistake, and I'll tell you why, right? Because cycles also matter in this scenario, right? So I'll give you examples of, in places like Marina, right? Marina, also the thing is, Marina is a very prime area, but within Marina you have
6 marinas. You have 6 marinas.
So different kinds of marinas, etc., and so forth, right? So we've had properties that are probably high end, but have done really well because we did a short-term strategy with there, so income was really attractive, as well as a capital appreciation. Where we've gone into affordable areas like IMPZ or DSO, where we generate really good income, But because we came at a point and an entry price where we've also made really good capital appreciation on those as well too, right? I'll give you examples. We bought studios, or investors bought studios on the platform in IMPZ ranges between 205,000 dirhams to 220,000 dirhams. Last they were rented for 30,000 dirhams, right? So great income, but we sold them for 320. Wow. So 100,000 gain on a 200,000, 50% return, capital appreciation. So that debunks your thing. Hey, there's no capital appreciation. But buying that today at 320, is that going to go to 400, 420? I don't know, right? But we took advantage of that opportunity when the opportunity presented itself at that particular point in time. And they're still renting really well, 35, 37,000 dirhams. So when you look from income perspective, even 320 seems like an interesting buy. But one key concept that people don't think about when it comes to any investment, particularly real estate, is your holding power, right? And this is a very, very important concept that people ignore. Holding power is critical for any kind of investment, because what that does, it gives you control of your destiny. Mm-hmm. Because if you're holding power, regardless what happens in the cycle, you need to be able to hold your investment through the worst of times so you can get the opportunity to recover and exit. If you don't have the holding power, this is where you get desperate at the worst possible time and sell. Because a lot of people say, oh, I lost so much money in Dubai. It's like, no, you only lost because you sold it and because you had to sell it, right? People that bought in 2014 peak, if they had held it throughout now, they obviously recovered their price, but they've also made income throughout this process. So if you didn't have the holding power during the tough periods of COVID, etc., yeah, of course you would have lost money. But if you had the holding power, you recovered and you actually probably made a lot of money. So this is very critical, right? Like, don't overexpose yourself, buy or invest in things in a sensible manner. And that goes for everything, not just real estate, even stocks and so forth. You need to be able to hold through the tough times. In fact, take advantage if you think there's opportunities. These are cyclical, these are not structural problems. You can add more money. So during COVID, I told you, like, on average right now is for 5,000 dirhams investment. During COVID, our average ticket was probably around 15, 16,000 dirhams, because smart money was coming. Hey, listen, this is an opportunity for me to buy. Too risky for me to go buy $1 million dirham asset. But you know what? I'll put 100,000 dirhams because if I'm right, I'll make money. And those people, they obviously paid out.
And we define holding power as the ability to be able to leave you don't need the money.
Patient capital.
Correct? You don't need the money. So that's the first rule, that you invest the money that you don't need.
Correct.
And then I think it answers the question, what's better, time in the market or timing the market, correct? So
100%.
Time in the market is the answer, right?
Yeah, right. I'm a big fan of Warren Buffett, right? So that's one of the things he says, right? It's not about timing the market. It's how much time you spend in the market. And the other thing is, be fearful when others are greedy, and be greedy when others are fearful, right? The most greed you should have had was during COVID, right? But this question gets asked a lot, right? Is it a good time to buy in Dubai, right? Or is it a good time to buy real estate? Like, I don't know, right? Every time is a good time to buy real estate.
But if you stay 20 years, for sure you'll make return, or 10 years or 5 years.
What's your horizon? What are you investing, etc.? Are you speculating? If you're speculating, then maybe no. You want to be careful. But if you have a long-term view, of course. Buy today, buy yesterday, buy tomorrow. It doesn't matter, right? Like, if you're buying something that is 1,200 dirhams per square foot, you're buying thinking this is going to go to 1,800 dirhams per square foot, for example. Does it really matter if you buy it at 1,100 or 1,150 or 1,250 per square foot? It doesn't, because your view is it's going to go to 1,800 dirhams per square foot, and you're going to make rental income during that period. Does it really make a difference? It doesn't, right? Like, for example,
not really.
to make it more nominal, it's $1 million dirham property. You think it's going to go to 1.5 million. Does it matter if you buy 950, 925, 975, $1,050,000? Obviously, from a relative perspective, I'm giving a very simple example on a smaller property, but it shouldn't matter because you'll make up that money over time, right? If you try to wait for it to come to 800 to buy it because you think million's gone too much, it might be 1.1 and 1.2 million, then you end up buying it at 1.1 or 2 million, and then market goes and you start panicking. Oh my God, I should have bought it when it was $1 million. Why it's back to $1 million? I'll sell it, get out, and then 4 years later it's back to 1.5. Like, oh, why did I do that?
Yeah, no one buys at the perfect peak.
Yeah, exactly.
Or the perfect value, right?
Take emotions. That's what we try to do with our platform. We try to take emotions out of it, right? So like, hey, here's all the information. It's purely numbers. I still have a lot of people that come to me and like, hey, I didn't like the pictures of that property, so I didn't buy it or invest in it. Like, who cares about the pictures, right? There's a lot of stuff that, I talked about IMPZ, DSO, right? Like, if you went and sold those apartments, you probably never buy them because you would never live in those properties, for example, right? I don't want to belittle anyone over here, but there's different segments of population in Dubai, etc. And there's certain elements of certain real estate that if you, as a family person, you're going like, wow, I couldn't live in this place, right? But it doesn't matter. It's a great investment. So take emotions out of it. Look at it purely from an investment perspective, and buy, invest in from that perspective, right?
So we ran out of time. I think we could be here 1 more hour.
Absolutely.
I had a lot of questions left, but let me finish with the last one. You talk about a couple of books, but what does it inspire you? Where do you seek inspiration, and what can you recommend to our listeners? In terms of books, podcasts, I think you mentioned the Rich Dad, Poor Dad. Rich Dad, Poor Dad.
Financial literacy is very, very poor, right? So that's a very good fundamental book. If you haven't read it, you should read it. You should definitely get your kids to read it, right? Because instilling these sort of concepts at an early age are very, very critical. Because simple home economics are not taught in school and so forth. That's a phenomenal book. It's a simple book for you to read and get your kids to read.
So which one? Sorry, which title?
Rich Dad, Poor Dad.
Okay.
Very famous.
Easy
to find on Amazon, etc., and so forth. The other one would be Psychology of Money. I think it's another good book to read, just to understand how you think about capital, making money, and so forth. Very, very important. And then other inspirations is just I'm a big capital markets follower, etc. I look at macro, micro. Real estate is a massive passion. So, anything that allows you to understand, look at data, trends, etc., and make sense of them, that helps me a lot, right? Like I'm a puzzle solver, we even at home with my kids, free time, we make puzzles, right? So solving puzzles, connecting the dots is very important. So anything that helps you with that kind of thinking, that kind of thought process, it helps you sort of make sense of what's happening in the world, because nothing is linear, right? A lot of people think everything is linear, but it's not, right? So, that's how I think.
Okay, so thank you very much. With that, we leave it here. Thanks for coming and for letting understand your business, the real estate, how to invest mainly, and for everyone. So see you next episode.
Thanks for having me.
Thank you.
Thank you.
Next Gen Rentals is brought to you by our main sponsor, Mr. Alfred. Mr. Alfred specializes in making vacation rental management effortless.